If you decide to build a portfolio from scratch, you have to sift through thousands of individual companies, guessing which ones might succeed. That requires massive amounts of research, and the financial stakes for getting it wrong rest entirely on your shoulders. But professional investors and everyday savers have relied on a different mechanism for decades to bypass that exact anxiety: the mutual fund. A mutual fund takes capital from thousands of individuals, pooling it into one massive reservoir managed by a professional. Crucially, you don't own the underlying assets directly. You own shares of the fund, holding a proportional claim to whatever gains or losses the pool produces. You are making a very specific trade. You give up direct control over your investments, and in exchange, you get immediate access to a deeply diversified portfolio that would be too expensive to assemble on your own. Because you aren't making the daily decisions, every mutual fund is governed by a legally required document called a prospectus. Think of the prospectus as the fund's rulebook. It lays out the precise investment goals and sets hard boundaries on exactly what kinds of securities the manager is allowed to buy with your pooled money. Handing over your capital means trusting a manager's specific strategy. Reading the prospectus is the only definitive way to verify that their approach actually matches your personal financial timeline. When you buy a mutual fund, you aren't picking a winning company. You are selecting a broad macroeconomic strategy. For example, stock funds, also known as equity funds, invest primarily in shares of corporations. Their performance tracks with the size of the companies they target, or a specific focus, like value investing or growth investing. Bond funds take a different approach, building portfolios of loans that pay out regular interest. They provide a fixed income over time, though if broader market interest rates rise, the value of the existing bonds in the fund tends to drop. Money market funds strip out the volatility of stocks and long-term bonds almost entirely. They hold highly liquid, short-term debt, like U.S. Treasury bills, making them one of the safest options available. Managers can also combine these approaches. Hybrid funds mix stocks and bonds to spread risk. Index funds passively mirror a specific market benchmark, like the S&P 500. And target date funds automatically shift your money into safer assets as you approach retirement. The variety of this menu means you no longer have to isolate individual winners. You simply pick the precise risk profile and time horizon that matches your life. The trade-off for this massive diversification is a loss of speed. You cannot trade mutual fund shares throughout the day at a constantly updating market price. Instead, mutual funds are priced exactly once per day, using a mechanism called the net asset value, or NAV. This equation shows exactly how that single price is calculated. At the end of the business day, the fund takes its total assets, subtracts its liabilities, and divides that result by the total number of shares outstanding. The manager's job is to increase the asset side of that equation. They do this by collecting interest payments, earning dividends, or generating capital gains when they sell a security for a profit. You give up the ability to make split-second trades. In return, you get a stabilized daily valuation that accurately reflects the true end-of-day worth of a massive, complex portfolio. Outsourcing the management of your money to a professional is a service, and that service carries inherent costs. Those costs hit your balance sheet in several ways. You might pay sales loads, which are commissions charged when buying or selling. There are often redemption fees for selling shares too quickly, and virtually all funds charge an ongoing expense ratio, an annual fee to cover operating costs that typically ranges between 1 and 3%. Beyond the direct fees, you absorb structural risks. There is management risk if the fund manager makes poor decisions, market risk if the entire sector drops in value, and liquidity risk if you need to cash out quickly and cannot sell your shares at a fair price. These fees and risks are the price of admission. They are subtracted directly from your overall wealth generation, meaning the fund must perform well enough to cover its own costs before you see a real profit. Today, mutual funds face heavy competition from ETFs, or exchange-traded funds. ETFs offer similar diversification, but trade continuously throughout the day, are generally more tax-efficient, and often carry lower average expense ratios. The difference largely comes down to how they are run. Mutual funds are usually actively managed by professionals trying to beat the market, while most ETFs are passive tools designed to simply match a market index. Mutual funds opened up institutional-level diversification to everyday savers, but delegating the daily trading doesn't excuse you from the responsibility of your wealth. You still have to read the prospectus, calculate your fees, and ensure the fund strategy actually aligns with your goals.